Sure. I'll start with a quick introduction. I'm Jordan Sachs from NASDAQ, leading our East Coast IPO efforts, working with private companies in all stages, in all shapes and sizes.
Sean McGregor, an executive director at JP Morgan. I focus in healthcare and particularly biopharma. Spend my time with mid-cap companies about 75% of the time, as well as large pharma about a quarter of the time. Excited to speak to you all today.
And I'm Zach Cantor. I'm a managing director in the software investment banking group at JP Morgan, based in Boston. Okay, so the markets have been good. So look, this four quadrant kind of sums up a lot of what you guys have all probably been seeing. I don't think there's anything here which is terribly shocking. I think the key drivers here behind sort of what's going on in the market, I think inflation has had a huge impact on things. The Fed has gone to extraordinary measures, and they're continuing to do so to try and cut into inflation. I think that I don't have the slide here, but I don't think I have it here. But there is an unbelievable inverse correlation between valuation multiples for high growth technology companies and interest rates, and they just move in total lockstep. And so as rates have continued to go up, multiples have continued to go down. And so I think that in terms of what's going to turn the tide on the market, I wish I could sit up here and tell you that I had like the silver bullet and January 1st everything would be back to where we were in 2020 and 2021 from a market perspective. I can't say that, but I do think that where we were, where we are today versus where we were in 2021 from an IPO perspective, the market's been closed for quite a while, and I think that as valuations kind of get back to, or settle in, and I think that private market investors kind of coalesce around the prevailing market multiples, I think that we will see a return to more activity. I think we'll see public market, the traditional large buyers of public market IPOs, we'll see the appetite start to increase, and I think that we'll start to see the market for IPOs open up again in earnest. If we go to the next slide. Let me just pop over here so I don't fumble around this stuff. So what you see here is, this again summarizes what we're seeing in the market. From 2017 to 2021, we saw, really an unprecedented growth in software IPOs. In 2021, we had 46 software IPOs, which was a record, all-time record. JP Morgan underwrote 38 software IPOs, which is the most by any investment bank in any one-year period ever. A lot of really marquee logos on the page. 2022, there have been zero. Now, Mobileye is in the market. Looks like they're going to have, I think, a successful IPO. I'm not working on it, but we'll see. I do think that the IPO market is going to come back. It's just going to take a little bit of time. And so I think that as you are sitting out there thinking about, I want to go be a public company, we have the right company, we have the right team, et cetera. When do I start thinking about doing it? I think now is a good time to start having those conversations and thinking about, what do I need to put in place? Do I have the right ERP solution? Do I have the right legal advisor? Do I have the right team? Who should I be talking to about taking the next steps in the process? Because the preparation that you do in advance of an IPO, it pays off. So this slide gives you a look at how software companies at the time of IPO, what their financial profile looks like, and how it's evolved over the last several years. And so the size of the company has gone up dramatically. Now this is, we're looking at, a lot of different companies, and this is mean data. So there are still smaller companies that are going public and have been going public. But by and large, the size of the company at the time of IPO is bigger. They're growing, as fast, but there's just way more scale. And so what's driving that? Well, access to capital in the private markets has, had gotten substantially easier. And it was sort of accepted and easy for companies to stay private longer and continue to grow kind of in the comforts of the private markets. Whereas, back in 2015, 16, 17, company got to be about $100 million of revenue, and it was time to go public. The other thing which I think is interesting is that, historically, what did a software IPO look like? Well, it was a company that was VC backed, that was growing really, really fast, that was burning a ton of cash, and they were ready to go public. Last year, I think what we saw was we still saw some of those companies, but we also saw a diversity of other types of companies that were maybe private equity backed, that had debt on their balance sheets, that had been public before, that had gone through an LBO, that were very profitable, that maybe had modest growth or had a nice combination of growth and profitability. And so what we found, and part of what led to really the boom in IPOs, was that there were different types of software companies which appealed to different types of public market investors. And part of that is why you see the size of the average IPO increasing substantially over the last 5 years. So this page looks at how investor appetites have evolved towards more profitable businesses, and what the correlation. So if you were to do a statistical comparison between revenue growth and a revenue multiple versus Rule of 40 and multiple, you see that sort of in this past spring there was this cross that took place where there was a better statistical correlation between having a combination of growth and profitability to what your valuation would look like than if you were just growing really fast. And that's new. I mean, over the last several years, that was not the case. And it was grow. And now I think, for obvious reasons, there's a substantial premium on, having a sustainable financial profile. Will it stay like this for forever? No, it won't. What will be the catalyst to cause it to change? I can't tell you. But there will come a time at some point in the future when investors will have forgotten about this sell-off, and there will be a go-go attitude again. But I think for the time being, anyways, I do think that there is a very strong focus on companies which, if they're not profitable today, they have a very clear path to profitability. But at the same time, growth is going to continue to be a key driver of value, and so you have to be Goldilocks, unfortunately, in this market. This kind of reinforces that point. So if you look at the left-hand side of this page, this looks at the highest valued tech companies, going back to the peak of the market versus what it looks like today. And what you'll see is that, obviously the multiples are substantially lower, but also that companies which are valued the highest today have a very high Rule of 40. Now, Rule of 40 it's not a panacea metric. It's just taking your revenue growth and combining it with either your EBITDA margin or your free cash flow margin. And it's crude. You're just mashing together two statistics. There's a lot of different rules of 40, right? You could have a company that's got 50% revenue growth and negative 10% free cash flow margins. That would be a Rule of 40 company. But setting aside outliers, I think in principle or in practice, it is an interesting measure to look at companies that have a combination of growth and profitability today are trading in a sort of a different behavior pattern than those that are just purely focused on growth or have been focused on growth. So then this is kind of a summary of what do investors look for in a high quality IPO. I don't think this has changed from back when, back in the boom of 2020 and 2021 or in the pre-COVID era. These are sort of core tenets of what makes for a good company, right? It's having a large market opportunity, having strong, loyal customer base, having defensible barriers to entry and competitive differentiation, having size and scale, which is obviously hugely important as a public company, growing and being able to show clear levers for future growth, having predictable business model, which is hugely important, and I'll get to this also on the next page around KPIs. But having high retention, right, and stickiness of your customer base, particularly in this sort of SaaS world that we all live in, I think it's hugely important for investors to be able to see the path for continued growth within your customer base, and then profitability. So then lastly, this came up a little bit in one of the discussions earlier around selecting the right KPIs. The right breadcrumbs, future-proof, reliable, easy to understand, not too proprietary. And so the way I would think about it is you want to have metrics that you use as a company, right? What you don't want to do in an IPO preparation process is, hey, let's create some new statistics that we've never looked at before because some other people are doing it. So you want to use stats that you use to govern and run the business, ones that are easily replicable, ones that you track, that you don't have to go and manually create on a monthly or quarterly basis, because that's probably not going to hold up to the rigors of being a public company and closing the books on time. You want numbers which tell a good story and tell an honest story, right? So you want to make sure you have metrics which, when you have a great quarter and the business is performing really, really well, the KPIs align with that story. You don't want to have KPIs which tell cross currents, right? You don't want to have a great quarter, but the KPIs are kind of dipping for some anomalous reason. So you want to have reliable KPIs. You want to have KPIs that are generally easy to understand and ones which are not too bespoke, because oftentimes around things like dollar-based net retention or around ARR, there's sort of the standard, which everybody uses, but then there's also, well, what if we use like fully run rated ARR? Or what if we look at net retention, but only for customers of a certain size? Those things are okay, but you want to think about them in the context of the whole story and make sure that you and your advisors agree that it tells the best story. And then lastly, here's some just general key metrics to think about. I think unit economics has increasingly become a focus area for investors, and so you see LTV to CAC payback period have become increasingly important. Dollar-based net retention is essentially required for a public software company today. ARR, free cash flow, important. I would say EBITDA margin, probably less important. If you're a company that tracks EBITDA and like you think about the profitability of your business on an EBITDA basis, then it's fine to include it, but I think free cash flow is probably more important. Let me pause there. I went through a lot of stuff. Any questions or comments? Okay.
So we prepared slides that were focused both on the macro environment, and maybe I'll touch less upon that here, just given what Zach just walked through. I'd say just at a high level, the XBI has been down 30% year to date, obviously due to a numerous amount of macro factors here. But I think we wanted to talk a little bit about how we're starting to see some signs of life. While the markets have faced significant headwinds in 2022, there's also some signs of life. I'd say there's two things that we've been focused most recently on in terms of stock price reactions following data catalysts. At the beginning of the year, there was basically four outcomes from releasing data, and all of them were negative. So if you had bad news, your stock price went down. If you had data that was hard to interpret, your stock price went down. If you had positive data, then your stock price would either go down because they thought you would sell, they thought you would be raising money and then they would sell, or they were thinking that it was a liquidity event in which there was a number of shares being traded that otherwise would not be afterwards. So obviously companies and boards were significantly frustrated with the inability to have any reward for positive data. So one of the things that we've seen most recently is that for companies that are public, when they release positive data, they've seen a significant uplift, allowing them to finance as well on the back of it. We've seen some limited but more frequent M&A announcements. So one of the things in the first half of the year that was a consternation for investors was that there was no recycling of capital. So with some of the recent announcements, Global Blood, for example, in which investors are able to take money out, get a premium from where they invested in, and put that back into the market. Obviously, today at much lower valuations than they were in 2020 and 2021. Obviously, that's helpful for the market and something that we're thinking is going to continue going into 2023. While we're here to talk about IPOs, I think one of the considerations here in today's market is that for private companies, a lot more, and we're in a lot more dialogue with private companies on strategic objectives and strategic alternatives. So even if they are not pursuing an IPO today or beginning the process for an IPO to be listed in the first half of 2023, what are the partnering opportunities for some of their key assets or therapeutic areas? Where are potential buyers and where are the takeout values today? What is the strategic rationale for pharma? I was having this conversation earlier, but a lot of people are questioning where is large pharma and what are they thinking? Are they going to be moving ahead with increasing the pace of acquisitions today because of depressed valuations, but they're not. They're steady on their course. Everything's about strategic rationale. It's not about valuation. That's where the people who are making the decisions within those organizations are held accountable. They're going to be, they're not going to be rewarded for buying an asset, a potential asset at a lower valuation. They're going to be rewarded for something that makes scientific and strategic sense for the organization. And so that is that is kind of the first question that large pharma is trying to answer today. Maybe just turning back to the IPO side, there were 76 companies that were listed in biotech companies that were listed in 2021. There are 9 in 2022. So a significant downturn in the number of companies, a significant downturn in pace. I'd also just note that because of the number of companies that are now public and the cash burns that they do have, something's got to change in that. Investors are requiring public companies today to be more focused in their use of proceeds. So while before a lot of the discussions were regarding platform companies and the ability to target a number of different opportunities, I think investors are a little bit more focused on how are they conserving capital, how are they going to be able to reach their next clinical milestone, as opposed to, giving them freedom to operate in such a way that they can, pursue 20 different targets or programs. So this is a little bit on the IPO market, and the volume obviously is down. Pricing outcomes are obviously in 2020 and 2021, or in the second half of 2020 and 2021, a lot of companies were being priced at or above the pricing range. All recent IPOs are priced within the range. So, they're clearly, investors, companies, and boards are clearly defining what is the right valuation for these companies and not trying to push the limits there. They're more concerned with aftermarket performance. If you look at the aftermarket performance for 2021 IPOs, they're about 90% are below issue, and about a third of the 2022 IPOs are below issue. So obviously people are obviously a smaller data set, but people are dialing in a little bit more on valuation today. And because investors are more focused on valuation at the time of IPO, the books are a little bit more concentrated. And so the investors that we want to bring into the book there are obviously more focused on the long-term growth profile and the long-term objectives of the companies, so there's less turnover in the stock. So this is just another page kind of walking through the same details, but I did want to spend just a little bit of time focusing on some of the key items in successful preparation and execution of biotech IPOs. And I think we walked through a lot of that in some of the panels before. And obviously the first one that I omitted from this page, but is obviously critical, and is having the right team around you, really dialing that in at the outset, having the leadership team in place that will be able to articulate the story to investors. One of the keys that we found too in determining the right time for an IPO is insider support. So where are insiders thinking? What do your investors believe? What does the board want to do? So really defining that up front is critical for us in the process of when is the right time for an IPO and what are the objectives of the company and the board. I think the next critical item is refining the equity story. So this is, I think, where we have found companies struggle a bit too, and sometimes it comes to a head during the drafting process. So companies may be pursuing different therapeutic areas, they have different programs, and it's unclear which ones they're going to be focusing in first. Where's the next catalyst going to come from, and where should investors be focused when doing their diligence, and where will value be attributed to the company going forward? Which programs are going to have the most value? And another point that we also try to define too is when looking at the broader competitive landscape, where does this company fit in? I think that's, for example, for type 2s with Bristol Myers and there being competitor programs in type 2, where is the differentiation between the different programs, as there are a number of companies targeting that. So, really defining that and being able to articulate that to investors is critical. And then also understanding where are your internal areas of expertise and where will you need external support and or partners. So obviously there's, companies have a number of different capabilities and opportunities that they could go after, but with limited resources and limited time, what programs or therapeutic areas will you be looking to partner off, and at what time will you be looking to do so? Will you be looking for different inflection points in which you can achieve a higher valuation or a higher upfront during the partnering process? Or is that something that will be pursued today or is being pursued today? Obviously critical in the IPO process, and we discussed this before, was defining your milestones, and I think that's critical. Being able to map out for investors today what is going to be coming to them in the next 6 to 12 months. The news flow is critical. Before they were providing companies with a longer time frame in order to provide data, and these days it's closer to 6 and 12 months, because before in 2020 and 2021 there was a lot more preclinical companies going public, a lot more platform type companies, and I think investors are now more focused on those with clinical data in hand that they can diligence and that they can compare to competitors. So I think that's critical as well. Also, a key point for companies during this process is preparing a budget, cash runway, and use of proceeds story. So, that kind of ties to where your focus will be as well. But investors are more, along with everything else, are more focused on where each dollar is going than before, and also identifying where your cash runway is today prior to an IPO as where it will be post-IPO. In this process, it's also critical to discuss valuation objectives of the board and insiders in the context of the overall market. So this will, we'll have a sense in where management and the board is thinking prior to an IPO. But during the IPO, we'll get feedback from investors and insiders, which will be critical in forming the basis of our decisions for, where valuation or where a potential valuation for a company may be at the time of the IPO. As Zach mentioned, a little bit self-serving, but obviously identify your IPO advisors early, legal, auditors, banks. Help us help you. I think that's the critical thing. We're here to help. We're working with companies earlier and earlier to help refine their equity story, help think through the competitive landscape and how companies fit in and how best to articulate your story to investors. One thing that we've also found during the IPO process is that sometimes management teams are not as prepared for the diligence that's going to be required in the process. So, one of the points of diligence for both the banks as well as the research analysts within the bank is identifying KOLs that are supportive of your company, your programs, your approach. So we find that to, sometimes in the processes we've found that no KOLs were as familiar, so we're more going based off of people that were established in the field. And really you want someone that can really tell your story for you, because research analysts will rely on their input when drafting their initiating coverage. And just turning to execution and timing considerations here, obviously based on 9 IPOs going, the macro environment and the calendar of economic releases are critical. We're focused on that through the end of the year. There's only one biotech company that has flipped public and is, anticipated to be a public company by the end of the year. I think, and I don't want to steal Jordan's thunder here, but the first half of the year, and I can only speak from our perspective, is that there's been less focus on drafting for companies to go public in the first half of the year, but there's obviously a number of companies we already have on file, and it's whether and which companies will be the right companies to go public in the market next year. I think when thinking about timing considerations, you also want to look at peer group performance and data releases. The way we used to look from a valuation perspective a couple of years ago was where did precedent IPOs trade? But now it's where are peers trading, because those are lower than where most precedent IPOs were done. So obviously that's critical. And what are the new hot areas? What are the new hot targets? Where is large pharma focusing? I don't think anyone would. I think some investors expressed that they were a little surprised that 2 sickle cell diseases were taking out within a month of each other in August. So obviously, large pharma, has a view that, not all investors are privy to, and now, they make decisions based on that. I think I focus on the rest of these: insider and new investor support and timing of upcoming catalysts, and also just financial staleness in order to define what is the right windows for launch.
So I'll just pick up, because we have a unique data set at NASDAQ that is forward-looking. So we have, with 99% of the biopharma IPOs at NASDAQ, we get the data of the applications coming in that are like 12 to 18 months out. And what I can tell you is, we still have a backlog of about 55 biopharma IPOs that are started the process, looking to go public. Timing is hurry up and wait. That's what we hear. But there are good companies with good management and great science. And I joke that in healthcare, short-term investor is 5 years, long-term is like 10 plus. So they're less concerned with the quarterly economic data as a tech company would be. And that's why you see in this brutal IPO market, 7 or 8 healthcare IPOs. It's really hard to benchmark to last year, which I think is an outlier year. I've been doing this for 18 years, and I've never seen 80-plus biopharma IPOs ever. For those in the room that remember when there were 4 or 5 a year, that was a lot. People got excited when there were 12. So it looks a lot more like 2015, 16 to me. But the good news is, I think if you're a pre-revenue biopharma versus a revenue-generating biopharma, it's a different story, right? There's a revenue cliff for the pharma companies that's huge. So there's one type of profile company that they're looking for. And then for the other innovative, I call it innovation in healthcare, if you want to deploy capital into real innovation, it's really the biopharma space and some enterprise tech. And if you look at the data of the IPOs, 80% of the IPOs last few years have been healthcare or technology. And that's because long-term investors want to deploy capital into innovation to get outsized returns. So there will be a few must-own tech names that come out next year that we're excited about. Hopefully that will open up the market for more technology IPOs. We do think that there will be second half of the year we're hearing people are more excited about. Obviously, there's nothing that people are talking about for the first quarter that's really, going to break the news cycle. I think, you're coming off the JP Morgan Healthcare Conference. There should be hopefully some great news flow out there. You'll see companies start to think about talking to the banks and orging up. But again, the Feds could be a huge piece of this for the technology side. And then on the healthcare side, there's a lot of companies out there that need to be ingested by the public investors, right? There's just over 750 now. And to your point, differentiation, if you're an IO company, or there are a lot. Fidelity can only own so many gene therapy companies, right? At some point, they have to make a decision, a portfolio bet, and say, this is our exposure. And we're starting to see selectivity in the biopharma market, but it doesn't mean that the market's closed. So it's just not going to be like last year. So I'll pause there, see if you guys have any questions. But the good news is, from the conversations that we're having with companies, they're still planning a path to an IPO. The crossover, the step up, may be a lot less. You're not going to see these crazy crossover step ups with no data milestones that you saw in previous years. I think you're going to see, as we mentioned earlier, the book allocations. You're going to see much tighter, definitely fully covered by the existing investors. And when we were doing this in 2020, there were IPOs in biopharma that had a 12x multiple on the book, oversubscription, which is insane. That's like a tech multiple, right? So that's come down. When you look at the recent ones, they're all 4, 5, 6, which is a very healthy oversubscription number, and completely backstopped by the investor base.
And maybe certainly the oversubscription has gone significantly down. I think what we've seen in the Third Harmonic and Prime Medicine IPOs, which are really the two marquee IPOs in the third quarter or fourth quarter now, is that there's been a number of new investors who came into the book. So people, took a lot of encouragement from that. About a third in the third Harmonic IPO, about 50% of the Prime IPO were allocated to new investors. So obviously that's critical in the market, because insiders, while they have to support and have to backstop at launch the IPO, it's critical to have those new investors come in and support the story.
Right, and that drives the demand, which creates even more interest and becomes a self-fulfilling prophecy.
Yeah.
One question there. So it's a good question. We actually have a really good tech backlog. I think with the tech side of our practice, what we're seeing is more and more conversations around valuation, right? Because biotech, the valuation, I think it's a little more straightforward. It's a DCF on the problem with the tech backlog that we have is that you were able to raise money at massive valuations in the past. Back to the earlier slide where you look at growth and profitability, where they cross. The companies that were just hyper growth and not clear path to profitability, it's a hard investor story to tell in this market, right? You're either doing a down round, you have a ratchet, there's going to be some sort of mechanic that has to happen to readjust to the current market conditions. So you either have to take the down round and chug it out as a public company, or stay private. And there's a lot of capital in the private markets. I mean, it's not the good news. If you're a private company, you can stay private longer. If you look at the timeline to an IPO as a private, there's plenty of capital. The terms might be different, but whereas biotech, these IPOs are just public financing events. They're not these massive, IPO like a tech enterprise company would have. So I think for the tech companies, we're going to see that play out next year when they stay private and they look at the terms for financing and what those look like versus what the IPO market looks like. There's the four-letter word that we've talked about earlier called SPACs. I think that has played its course, but there are still some SPACs that actually do add value. With the pipe, you can bring in some investors. You don't get the research coverage that you normally get with an IPO. So there's pros and cons to a SPAC. But I think when you look at how many SPAC products are still out there, you're going to see the ones that are truly differentiated with quality sponsors that can add real value, put together a meaningful pipe with quality investors, do transactions that will still continue. That's the one thing that's happening this year outside of the lack of IPOs is announced business combinations. So we'll continue to see that trend. But I think for the tech market, I'm looking over at Sean and Zach, but I think it's going to be a hard valuation story. If you're willing, depending on what you raised at last versus your current path to profitability, is going to determine when you make it out.
Yeah, quick question. Just curious, reverse mergers, are they still out there as somewhat of an alternative?
Yeah, we've got one announced that's going to close the end of this year. We call them like clean shells. There's a list on NASDAQ website you can go and see. I think there's like 80 of them or something, where they're actually just clean shells that you can reverse merge into. I don't know if you guys get a lot of calls on the biotech side, but we're seeing more and more companies ask about that as an option, and we provide them the list of the shells. And there's definitely one or two out there that will go this year.
Yeah, I mean, there's certainly very competitive processes these days with the number of companies that have traded down towards cash levels or below cash levels and are seeking, exits for their investors and seeking private partners that they can go with. I think one of the things we've seen is that sometimes the winner of that process has to give up a lot of ownership. So, while you're trying to find the right, partner that has strategic rationale for you going forward and for your prior investor base or the public shell's prior investor base, the difficulty is that for a private company, you do tend to have to give up a lot of ownership in order to kind of win that really competitive process, because we're seeing 40 plus people being called in those processes.
Question for Sean. How have you seen the IRA impact the small molecule companies, impact valuation, and is it a factor when you think about the story, as you tell your story?
Yeah, I mean, it's a good question. I mean, we've spoken to our analysts a lot regarding that and how they're thinking about whether there should be any discount associated with it. I think they feel like the IRA has, while there's, a long-term effect associated with it, people will start viewing, may start viewing small molecules differently and where the valuations will be. However, in the long term, they don't see it as a significant discount to where it was or where it would be prior to the IRA. So we still believe that while the IRA has kind of maybe provided some limited duration on those potential assets, there still should not be a discount associated with differentiated products, that are able to serve a large unmet need and, have a large patient population. So I think for key clinical assets, I don't think there's going to be a valuation discount associated with it.